Hey everybody, welcome back to 5 Minute Financial Markets. Well, today may very well have kicked off the biggest week of the year, and we kicked it off with a bang. Friday we talked about how the S&P closed just outside of this parallel channel that it had been in for the last 2 months, and today it rejected hard back into the channel on a really powerful end of day rally. Let's take a look at the intraday chart to see what happened. We opened here around 394. Early on we tested this green line, which was the low from 2 weeks ago. I've talked about before how the highs and lows from the previous days and previous weeks trading can be very significant levels of support and resistance. Keep those on your charts. Tested that level and bounced off, broke right through this 395 level and took off from there. Stayed above 395 the rest of the morning, and then right here with about 70 minutes to go, the short squeeze really began. And you can see us just melting higher for the last hour and change of the day, all the way up to 399. Now, I've talked about this in previous videos with the S&P. There are some days where it just blasts up, comes back down, and sort of chops around intraday. Those days are less predictable. Then there are other days like this where you get an intraday high, a slightly higher high, a slightly higher high, a slightly higher high, and by about halfway through the session, you're seeing 10, 12, 15 new intraday highs, just slightly higher than the ones before. On days like that, you can almost always expect continuation all the way into the close. So even here, when we got this big wick up and it rejected back down and spent the next 2 hours below that high, you know from the previous half of the day, all these higher highs, that if it does get above this high, it has a good chance of just continuing up higher the rest of the day. So knowing that, you could have gotten long here at around 396 and change, a little over 396, had ridden that all the way up to 399 at the end of the day. Using some same day SPY calls, slightly out of the money, you could have made a huge return on some very quick, low risk trades. So I mentioned that this is the biggest week of the year. First thing tomorrow morning, an hour before the market opens, we've got the CPI, the Consumer Price Index, inflation number. That is the biggest single driver of Fed decision making this year. They're trying to curb inflation, and as long as CPI remains elevated, they have to keep rates elevated as well to combat that. We've started to see the core inflation roll over from the peaks earlier this year, and right now the market's expecting 6.1% for core, 7.3% for total inflation. If we see anything lower than these numbers, this market is going to scream higher. And whenever I see big price moves toward the end of the day, heading into a big news event like the CPI, I always wonder if maybe there are some insiders who maybe have some inside information that maybe they're sharing with some other insiders and maybe making some trades based on that. Now, I know it's ridiculous because that's illegal, so that never, ever, 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 ever happens. But all I'm saying is if we get a low CPI number tomorrow and the market rips, I'm going to be very glad that I followed the crowd, getting long SPY calls, short dated toward the end of the day. Now, the other big piece of news, even bigger than the CPI, is the very next day, 11 a.m. Pacific time, the FOMC rate decision. They're going to be hiking interest rates 50 basis points. That's all but a done deal. The real suspense comes with the FOMC statement and the press conference with Jerome Powell afterwards. What kind of language are they going to be using, and are they going to send the market a dovish or a hawkish signal going forward? Now, a lot of that will probably depend on what the CPI number is tomorrow, but I suspect we're going to get a CPI number in line with expectations, maybe slightly below, and I expect the Fed to increase the dovish tone that has started to sneak into their language over the last month or so. Let's take a quick look back at something interesting. Now we're looking at the SPY daily chart. I've got these vertical blue lines for every single Fed meeting this year. Look what happens in advance of almost every single meeting we've had. So here we've got the January 26th Fed meeting, and we have this 12.5% sell-off heading into that meeting. Then we look at the next Fed meeting in March, and from the peak here, we've got a 9% sell-off heading into that meeting. We look at the next meeting in May, we've got a 10% sell-off heading into that meeting. The next meeting in June, in 4 days, we lost 11%. Look at that. Gap lower, gap lower, gap lower, heading into the Fed meeting. A big sell-off heading into the September meeting, 12.5% there. Mini sell-off heading into the October meeting. And now here, before today, a 4% sell-off heading into this meeting. Now, most of these Fed meetings that were preceded by big sell-offs were followed by big rallies. January, March, May did not have the big rally, but June certainly did. Look at that massive, the biggest rally of the year came after the biggest sell-off of the year, right before the June Fed meeting. And then a big sell-off heading into September, which followed through a little bit, but then we've been in a nice uptrend ever since then. Just something to keep in mind when we see these sell-offs heading into Fed meetings. Let's take a quick look at the VIX, the volatility index, which was way up today, 9.5%. Now, I know what you're thinking. Normally when the VIX is up, that means the market's down. Normally when the market's up, the VIX is down. So why are the S&P and the VIX both up on the same day? And the answer is implied volatilities. People are buying options for protection today. People are scared that there's going to be a big move one way or the other. Maybe they want to protect their investments. Maybe they're trying to take a position to profit off the big move that's coming based on the CPI and the FOMC meeting. And so they're buying options in large amounts. When there are a lot of people buying the same thing, the price goes up. And there are four main components to options pricing. There's the price of the underlying asset, the strike price, the time to expiration, and implied volatility, which is what the VIX is. Implied volatility is what you're actually trading when you buy an option. Everything else is calculable. You can calculate the underlying price, you can calculate the strike price, you can calculate the number of days left till expiration. What you cannot calculate is the implied volatility. That is what the market is trading. So when a lot of people are buying options, surprise, surprise, the VIX goes up. Now you look at the correlation between the VIX and the S&P, and it's almost always right down here between negative 0.9 and negative 1. A very, very, very strong negative correlation. But every once in a while, that correlation breaks down on a day like today, when you've got the market moving up and people buying large amounts of options. Incidentally, on a day like today, when implied volatility is really expensive, a better strategy than buying outright options is to buy spreads, buy call spreads and put spreads, where you buy one call at a certain strike price and sell another call at a higher strike price. You're simultaneously buying and selling implied volatility. It kind of reduces that impact. That's all I've got for today. Good luck tomorrow and Wednesday. It is going to be a wild ride. If you like this content, please hit like and subscribe, and we'll see you next time.